To understand managerial accounting, we must first distinguish it from the financial accounting you might already know. Financial accounting is primarily for outsiders, such as investors, creditors, and tax authorities. Because these stakeholders need consistent data to compare different companies, financial accounting must strictly follow GAAP, the generally accepted accounting principles. Managerial accounting, however, is designed specifically for internal decision makers like managers and executives. It provides them with detailed, often forward-looking information about specific segments of the company, like a single product line, a specific department, or even a regional office. While financial accounting is historical and reports on the company as a whole, managerial accounting is flexible, does not have to follow GAAP, and focuses on helping the organization achieve its future goals through data-driven planning and control. For instance, a manager might use these reports to decide whether to launch a new product or shut down a low-performing branch, details that would be lost in an aggregate financial statement. When we analyze the costs of a business, we first separate them into manufacturing and non-manufacturing costs. Manufacturing costs, or product costs, have three components. First, direct materials. These are the physical parts of the product, like the steel in a car or the flour in bread. Second is direct labor, which is the work of employees who are physically assembling those materials. The third category is manufacturing overhead. This is a catch-all for indirect costs like factory rent, utilities, and the salaries of factory supervisors who don't touch the product directly. On the other side, we have non-manufacturing costs, also known as period costs. These are not related to the production process and are expensed in the period they occur. These include selling costs, like marketing campaigns and delivery fees, and general and administrative costs, such as the salaries of executives or the rent for the corporate headquarters. Understanding this split is vital because product costs are often attached to inventory on the balance sheet, whereas period costs hit the income statement immediately. The method used to assign these costs depends on the nature of the production. If a company produces unique, custom-made items, it uses job order costing. Imagine a construction firm building a custom home or a law firm handling a specific case. They track every dollar of material and labor to that specific job. On the other hand, if a company mass produces identical items in a continuous flow, like a refinery producing gasoline or a factory making thousands of identical soda cans, it uses process costing. In process costing, we don't track costs for every individual unit. Instead, we average the total costs over all units produced during a specific time period to create a uniform cost per unit. Another important distinction in cost assignment is absorption versus variable costing. Under absorption costing, which GAAP requires, all manufacturing overhead is absorbed by the product. However, for internal management, variable costing is often used, where only variable overhead is included in product costs and fixed overhead is treated as a period expense. This provides a clearer picture of how costs change with production volume. Allocating manufacturing overhead can be done simply or with precision. Plant-wide costing uses a single overhead rate for the entire factory, often based on direct labor hours. However, this can be misleading if one product uses more electricity while another uses more machine setups. Activity-based costing, or ABC, solves this by assigning costs based on the actual resources consumed. First, we identify specific activities, like machine setups, quality inspections, or material handling. We then create a cost pool for each activity. Next, we identify a cost driver, the resource that primarily generates that cost. For example, the number of setups would drive the cost of the setup pool. Finally, we assign those costs to cost objects, which are the units of inventory or services being produced. While ABC is more complex and expensive to implement, it provides managers with a much more accurate understanding of product profitability, especially when production processes are diverse and overhead is a large portion of total costs. Cost volume profit, or CVP analysis, is a vital tool for planning. It relies on understanding the contribution margin. This is the amount left over from sales after all variable costs are paid. As the name suggests, this margin contributes to covering the company's fixed costs. Once those are covered, every additional dollar of contribution margin becomes profit. We calculate this by taking the selling price and subtracting the variable cost per unit. It is also important to remember the relevant range. This is the specific span of production volume where our assumptions about costs remain true. For example, if we suddenly double production, we might need to rent a second factory, which would change our fixed costs. Within the relevant range, however, fixed costs stay constant and variable costs per unit stay the same, allowing us to accurately predict how changes in volume will impact our bottom line. We use the contribution margin to find the break-even point, where total revenue equals total costs and profit is zero. To find the number of units needed to break even, we divide the total fixed costs by the contribution margin per unit. If we want to find the sales needed for a specific target profit, we simply add that profit amount to our fixed costs in the numerator. Beyond just breaking even, managers look at operating leverage. This measures how sensitive a company's income is to a change in sales. If a company has high fixed costs, like a software firm or an airline, it has high operating leverage. A small percentage increase in sales can lead to a massive percentage increase in profit because the fixed costs are already covered. However, it also means a small drop in sales could lead to a significant loss. We calculate the degree of operating leverage, or DOL, by dividing the total contribution margin by the operating profit. Finally, the margin of safety tells us how much sales can drop before we hit that break-even point, providing a vital measure of risk. Managerial accounting also involves making long-term investment decisions through capital budgeting. When a company considers buying a new machine or launching a new project, it uses several key metrics. The payback period is the simplest. It measures how long it takes for the initial investment to pay for itself in cash flows. A more sophisticated method is net present value, or NPV. This calculates the difference between the present value of all cash inflows and outflows, accounting for the time value of money. If the NPV is positive, the project is generally considered a good investment. Closely related is the internal rate of return, or IRR, which is the discount rate that makes the NPV equal to zero. When choosing between projects, managers must also consider opportunity costs, the benefits lost by choosing one option over another, and ignore sunk costs, which are past expenditures that cannot be recovered and should not influence future decisions. By focusing on these data-driven metrics, managers can ensure they are allocating the company's capital to the most profitable opportunities. In summary, managerial accounting is the engine of internal business strategy. By accurately classifying manufacturing and period costs, businesses can track their efficiency. Through methods like job order, process, and activity-based costing, they can precisely determine what their products actually cost to make. CVP analysis allows managers to set realistic sales targets, understand their break-even points, and manage the risks associated with operating leverage. Finally, capital budgeting tools like NPV and IRR ensure that long-term investments are grounded in financial reality. Unlike financial accounting, which reports on the past, these tools provide a roadmap for the future. By mastering these concepts, you can transform raw data into the actionable insights that drive a company's growth and stability in a competitive market.